The House Republicans' tax overhaul bill calls for reducing the tax burden on people who own small businesses like Steve's Bike Shop, not give breaks to professional athletes like Stephen Curry, the NBA All-Star. The rewrite of the tax code, which the House passed on Thursday, proposed a 25% tax rate for small businesses for owners who report their profits as income on their tax returns. It was slightly higher than the 20% rate for corporations but a break from the top individual rate of 39.6%. In the end, though, the bill might not help the fictional Steve or the real Steph, who were named in the bill. But Mr. Curry's wife, Aisha, a TV personality who receives royalties and licensing fees from businesses she represents, could get a tax break. The reason is that the proposals for taxing small business owners, whose companies are called pass-through entities, because the income passes through to their personal tax returns, hinge on the ownership of those entities. Those who make money passively, by owning part of a pass-through entity they do not run or receiving endorsements and licensing agreements through a passive vehicle, could structure their payments to achieve a lower tax rate. Those who are actively running a business that is structured as a pass-through, for instance, a limited liability company, an S-corporation or a partnership, will not see as great a reduction in taxes and may even see an increase in certain states. "It's not how much you make," said Edward Reitmeyer, partner at Markham, a national accounting firm. "It's how you make it." In other words, the House bill may seem like a tax cut for small businesses, but it is not likely to bring much relief to many of those owners, and it is certainly not comparable to what was proposed for large corporations. And some professions, like consultants, lawyers, doctors and other professional services companies, are not even eligible for the lower pass-through rate. What's really going to happen is, people are going to change their behavior based on this tax act, Mr. Reitmeyer said, like rethinking their business tax structure. The House bill says that up to 30% of business income can be taxed at the lower 25% rate, with the rest at the personal income tax rate. At the highest level, this is a blended tax rate of 35.22%, at least for businesses that qualify. That is a far cry from the 20% proposed for corporations. The Senate proposal, which is wending its way through the committee process, offers the possibility of a deduction of business income of up to 17.4%. But it still has hurdles. This week, it lost one Republican vote, when Senator Ron Johnson of Wisconsin opposed the different treatment for corporations and pass-through entities. What becomes of the two bills when they get reconciled is going to determine whether small business owners will pay less in taxes. But it will also determine what resources they will have to invest in their businesses and still maintain their lifestyles. The savviest business owners will begin by calling a sophisticated accountant or tax lawyer.